Good morning, student. As in previous video, we have discussed the various cases relating to PL appropriation account and the term charge against profit and appropriation of profit. Some of the doubts generated from your side, Ishani asked, कि manager commission will be treated as charge or as a appropriation. Somewhere in the book it is shown in the debit side of PL appropriation account, but as per the syllabus of class 12th, it is restricted that it should be treated as charge against profit, not as an appropriation of profit. So accordingly you will treat this item manager commission in the debit side of PL, not in the debit side of PL appropriation account. Now come to the next topic, that is what are the various methods to maintain partners capital account. This topic we will deal in various chapters: in admission of a partner, in retirement or death of a partner, at the time of dissolution of partner. In all these chapters we will prepare partners capital account. So let us understand the way how we will maintain partners capital account. There are two methods to prepare partners capital account: fixed capital method and fluctuating capital method. See, in pictorial representation I just represented here the two methods, how these two methods are to be maintained. In fixed capital account we have to maintain two accounts of each partner: capital account and current account. What items will come in the credit side and in the debit side of capital account, what items will come in the credit side or debit side of current account. And in this fluctuating capital method, only one capital account is maintained, that is partners capital account. What items will come in the debit side and what items will come in the credit side. So it means by comparing these two methods, this fixed capital method is a lengthy method because we have to prepare two accounts for each partner, and in fluctuating only one account, that is capital account, is maintained. If there is no method specified in the question, then by default you will follow fluctuating capital method. Let us start this topic. As we know well that in partnership minimum 2% and maximum 50% is required to start this business. So in this case we have to maintain the capital of each partner separately. The capital account that I already introduced, there are two methods. In first method, fixed capital, that is by the term fixed here means the capital. Under this method we prepare two cap account and the balance remain fixed. But where this balance remain fixed and where the balances remain changing, that is separated in two account. One is capital account and another one is current account. In capital account, capital never change, it remains constant, fixed. It remains fixed year after year, and changes only takes place. There are some exceptions to these rules. Sometime objective type questions also asked ki what are the two situation when fixed capital will also change. See, there are two situation. Number one, if additional capital is introduced by a partner and if withdrawal is made. Withdrawal here term used out of capital, that can be termed as drawings out of capital. So this is a permanent withdrawal of capital, so it is a part of capital account. That also leads to change in the balance in capital. So these are the two situations when fixed capital also changes. Now come to the second account, that is current account. It records the transactions. What are those transactions? Such as drawing against profit. So you must be very clear with this term, drawings out of capital and drawings against profit. Drawings against profit means on regular basis drawings are made by a partner. Interest charged on drawings and loss will be shown in the debit side, and appropriation in the form of interest on capital, salary, commission in the credit side of current account. So as a result, the balance of current account fluctuates. It may have debit balance or it may have credit balance, but in case of capital account, the balance always be credit, never be debit. So see, I just given you the way how you will maintain the capital account of partner. In this case, there are three partners, so you have to draw three columns each for partners. In the debit side, three columns for amount, and in the credit side, three columns for amount. And in this amount column, you will just write the name of the partner, and debit items in the particulars column, credit items in the particulars column. Here it is already written what items appears in the debit side of capital account, what item comes in the credit side of capital account, and in case of current account, I already it is mentioned what items will appear in the debit side of current account, what items will appear in the credit side of the current account. So this way you will prepare partners capital account if it is specified that you have to maintain by fixed capital method. When the balance will come in the credit side, you know what you mean by credit balance means BD comes in the credit side, then it will be transferred to the liability side of the balance sheet, है ना? And if credit balance in current account will also transfer to liability side, and if debit balance will come means BD in the debit side, then it will transfer to the asset side of the balance sheet. So this is the way how you will prepare partners capital account, that I already given you the format. Accordingly you just write it down in your accounts copy. Now moving ahead to the next topic, next method, that is fluctuating capital account method. Fluctuating means the balance keep on changing. Under this method, only one account named the capital account is maintained for each partners. This method is normally followed for maintaining capital account in the absence of an instruction or information. It may have debit or credit balance, means whatever item you were showing in two account, altogether all the items will appear in one account, partners capital account. See what items you are showing in the debit side and what items you are showing in the credit side. Whatever factor that leads to reduce the capital is appearing in the debit side, and the factors which increases the capital by providing interest on capital, salary, commission, profit. So these are the factors that leads to increase the capital. As you know well, what is the rule when there is a if you want to add the capital, you have to credit capital. So accordingly the rule of debit and credit is followed here, and this is the way how you will maintain partners capital account. So, and it may have debit or credit balance, means BD can come in the credit side or BD can come in the debit side. If it come in the credit side, where you will transfer in the liability side of the balance sheet, and if the balance comes in the debit side of partners capital account, where it will be transferred, that is in the asset side of the balance sheet. So this is the way how you will maintain capital account of each partners. It is just a format how you will prepare partners capital account. And see, some of the assignment also given, and do the assignment. You just solve the questions based on partners capital account, and few more question when appropriation is more than profit, that on that also I have given you the assignment. You just do it in your accounts copy, and more question, as much as question you can practice on this topic, because this topic you will come across in all the remaining chapters of partnership firm. So do all the questions accordingly. Thank you so much.